Okay. So basically we have two type of inflation. One is demand based inflation, other is supply based inflation. Though these two statements look identical, but they have a different understanding. One is where the demand is getting increased, and this demand is getting increased because of the higher inflows of the funds, or because of the higher investable surplus, or you can say extra income in the hands of the investor or the user, which incurs the demand on a higher side. We have a supply of, let's say, 100 units, and all of a sudden the demand has increased from 100 units to 102, 103, 105, 110, because of which the price of the commodity start rising, right? This creates inflation. Now this inflation is purely because of the demand side, because demand has increased. And why demand has increased? Because we have extra money in our hand. Now there's other side. When demand is same, if we have 100 units till date, and we was having this demand of 100 units also, but all of sudden we have reduced the demand, we reduce the supply, we have stopped producing it, we have stopped producing, we have started producing under the demand. That means demand is 100, demand has not risen, but supply has come down to 90. So in this case also, the price of the commodity will start rising, right? So that will also create inflation to come. Now this supply, when we cut the supply, there is a bigger example which actually fluctuates the commodity prices. Can anybody tell me what exactly that scenario is? That is a world economic scenario, and that happens every time, because of which a lot of fluctuation happens directly or indirectly to any product.
Exchange rates.
Exchange rates, no. What else? क्रूड, क्रूड
Or
का पढ़ते हैं ना, क्रूड में
So,
हम
um,
टेल मी.
so from what I understand, like I wrote in the chat box also. So let's say RBI corrects the suppose if there is high inflation, RBI corrects it by reducing the interest rate. That automatically limits the amount of money flowing, right?
As of now, we are not going to the interest rate. It is not necessary that RBI has reduced the interest rate, then we are having a surplus fund flow. Not necessary. If our economy is doing good, then also we have surplus fund flows. Interest rate can be high. For example, right now interest rates are quite high, but still the fund flow is so huge that investors are having high fund flows, and they are creating demand of the products like anything. So that is one scenario which you are saying, that is to great extent, yes, it is right. But again, it is not necessary that that is the one reason which creates inflation from the demand side.
so can you repeat the question that you asked before?
So I am saying ki demand side to we understand ki
Mhm.
where whenever we have surplus funds, that funds surplus of the funds could be one, which Elstay said that when RBI reduces the interest rate, we have extra money in our hand, because we are saving, we have to pay less now because interest rates have come down, and whatever loans we have to pay less, and we have extra money in our hand. So we start creating more demand. So one is that demand side. Other, it could be that we are getting higher incomes. For example, you guys might be getting a package of 6 lakh, 7 lakh, 8 lakh, 5 lakh, 10 lakh, like that. We started with a package of 2 lakhs, or maybe 1.5, 1.8, like that. There's a difference, and you are having higher packages. Maybe in a year or two, you all guys will be plus 10. It took us 10 years to come above 10, right? So that is also that you are getting higher, you can say, income, because economy is doing good. At that time, when we joined, when we started working, our economy is below 1 trillion. Right now we are standing at 3.3 trillion, so economy has also come 3 times, right? So things have changed, economy has grown, so that means more money is there in the system, that is coming
Mhm.
into your hand, and you're demanding more. But there's other example where we reduce supply. So can you give me examples where we increase inflation by reducing supply, or the inflation increases because of the reduction in supply?
Printing of currency.
Sorry, printing of
Printing of currency.
printing of currency will not increase inflation. Printing of currency
No,
will,
if we reduce it.
if we reduce it, so printing of currency happens when we have to give stimulus. Guys, I have to take this call. This is an emergency call. Just give me 2 minutes. Huh? Sorry, guys, some medical urgency, so I had to take this call. Okay. Everybody gone or there?
There, sir, there.
Good.
Yes, sir. We have.
Okay. So supply side inflation is basically by cutting or reducing the supply. So what are the examples? If we look into the domestic economy, onion, tomatoes, we
हाँ,
always get it. So cutting supply does not means intentionally cutting supply. It could be because of any other reason, like we had a very bad you can say produce, because of which demand increased. And I mean, demand was same, demand did increase, but ultimately supply was reduced. And one regular commodity which faces this particular thing is crude oil prices always fluctuate because of the supply cut and supply increase of the supply, right? So that is a because of supply side inflation. Now, thing is ki when we are talking about the economy, so coming back to Elstay's point, whenever we want to invest anything, so investments always look into with the two perspective majorly, aside from everything else, risk profiling and everything. So major perspective from any investment is two. One is risk. What is my risk? Second is reward, right? So when I have to look into risk, that means the first important thing out of that risk is ki whether my capital will come back or not, return of capital. And second is ki if my capital will come back, then what will be the return which will be taking it from that particular investment. Now, to understand that return, we have to understand the economy. Economy can be understood from which perspective? Equities or debt? Which is a better indicator for us to understand economy? Equities or debt?
Equity.
Equity. Shireen ma'am, look confused.
uh,
Sorry, only you two guys have switched on your camera, so I can only ask questions to you guys.
sir,
Elstay says both. Suraj is gone.
sir, I think debt, debt.
Debt. Okay. How debt?
सर उससे तो पता चलता है कि कितना हमने लोन लिया हुआ है एंड व्हाट इज द पेइंग कैपेसिटी और बाइंग परचेजिंग पावर के बारे में भी पता चलता है नॉट
Okay.
परचेजिंग पावर बट हाँ मतलब आर वी एबल टू पे आवर लोन्स एंड उसके हिसाब से
Okay. So, Suraj, Vedant, Harsh, Anirudh, anything from your side? These guys are happy switching off their cameras and ठीक है जाने तो कोई बात नहीं सर कुछ नहीं बोलने वाले. Okay. Since for the benefit of you three guys, Elstay, Shireen, and Ananya ma'am. So basically, what happens is कि when we talk about the economy, the major impact comes from debt market, because debt market is something which decides the future of the economy. How it decides? Let's take an example. Whenever we fell ill, right?
हम्म
So when we go to doctor, what does doctor says? Ki your immunity is weak. That's why
हम्म
we have fallen ill, right?
हम्म
As we grow old, since you are yet to come to that age, I have crossed 30, about to cross 40 also in a 2 years span of time. So how age works, how your activity of your body and how your immunity starts responding, that we understand later. So as my mother always used to say कि अच्छा खाओगे भी बचपन में तो वो बाद में काम आएगा. We couldn't understand that time.
हाँ
Now we can understand कि okay, whatever we had at that time, that is what is supporting our body right now, right?
हम्म
So for an economy, debt is like that. That is something which builds the immunity of this thing, what you can say economy. So Elster is saying some statement. So current state of the economy is reflected by the debt market. Yes. So current state of the economy is reflected by the debt markets action which were taken in the past. Because whatever action has been taken in the debt market, that reflects after 3 to 6 months. Debt market never responds immediately. Debt market responds, but it takes time. For example, when we started this lecture, I showed you that the yield curves has inverted, but
हम्म
economy is doing good. Yield curve
हम्म
is just inverted. Now this inversion is because we have been rising rates for last 6 months. We have not risen the rate. Had those rates been rising, then definitely we would have been in a difficult situation. Our yield curves would have been more deep and inverted, but it is
हम्म
just inverted, touch and go types.
हम्म
There's a dialogue of this thing. in a movie कि मौत को टक से छू के वापस आ गया, it is like that.
टक
So
से
yield
छूकर
का
वापस आ सकता हूँ.
तो yield का inversion टक से छू के वापस जा रहा है, right? The thing is कि when we see such situations, so this is the outcome for which action was taken 3 or 6 months back. So when RBI has raised the rates to a certain extent, which is beyond the expectation and which is beyond the, you can say, management, those things are coming up now. Now the rates which are now rising is because US is still saying that they are not able to handle the inflation till now. They have not, they don't have the full control of inflation situation till now, right? Because of which now still in the speculation, rates are rising. Now, whatever action happens in the bond market, we see the outcome in the equity market. So equity market responds quickly. So what happens is कि whatever action in the bond market has happened in the past, that gets reflected in the future. But in equity market always works in the future. That means what is going to happen in the future, that it shows in the present. So bond market shows us the past, equity market shows us the future. So if today I say that my bond market or my interest rates are not rising up further, so my equity market start rising up because interest rates are not rising further. That means stability in the interest rate has come. Now, what is the next action which will happen in the interest rate? Interest rate has to come down. There is no other way out. It cannot stay there for long because they are too high. And if they're coming down, that means my economy will grow. My economic activities will grow. My expansions will grow. So ultimately equity market will grow. So equity market is taking the future valuations, ki what the valuation of the market should be at that time. So equity markets work in the future, but they show the results instantaneously. Whereas bond market shows us the past. So 3 to 6 months, that means 1 to 2 quarters. What action we are taking today in that market, the repercussion of those things will be shown 3 to 6 months later in the economy. So for any investment, the important aspect is your interest rate. Interest rates decide everything how the economy is going to shape up in future. Now, interest rate also decides that what will be the expense out of the pocket of central government, what will be the expense out of the Reserve Bank of India, what will be the expense out of the banks. Why banks? Because banks pays us interest in the form of savings account interest, fixed deposit interest, right? Bond corporates pays us interest in the form of coupons, right? So interest plays a major role. If the expense of these corporates, banks, RBI, government, they all reduces because of the reduction in the interest rate, then definitely there will be a lot of surplus money which can help in growth of the economy. So whatever investment we have to decide, we have to first gauge the situation. What are we looking at in the future? What could be the probable future? Accordingly, we can choose the particular asset. So right now, standing over here, I'll just sum up, or you guys only answer me ki what you are looking. So as I told you, ki interest rate have risen to a certain level. Now we are not looking any further increase into the interest rate. So from here, explain me what could be the next probable future of the markets overall. Where do you see the markets and why? Okay, chalo, let me take it this way. So, Shireen ma'am, interest rates are not rising further, that we know. Maybe 0.25 basis points rise somewhere, so that's okay, but they are not rising. So, if they are not rising, so what will be the probable next thing which can happen?
So if they are not rising, so most pro नहीं sir.
Let's say you are standing in a lift, or let's say you are standing on an escalator, right? In the middle of an escalator. Escalator was going up. All of a sudden, you are on the airport, escalator was going up. All of a sudden, everything stopped, and there's an announcement that whatever was happening now, it will stay as it is, or it will start reversing, or it will stay, or it will keep continuing on its move. That means in the middle of the escalator, you have three ways to go. Either you start walking upstairs, or you start walking downstairs, or you stay for the light to come. Right? So now I'm saying that your upside is limited. Now
Okay.
replace yourself with the interest rate. Interest rate has upside limited. That means escalator which was taking interest rate on the upside, that is now stopped. RBI said that now interest rate will not go further up. Correct. So what is left with the interest rate? Either to stay there
Or to go down.
or to go down.
हाँ
Up it cannot go.
हाँ
Upside is blocked. Correct.
हाँ
So it will either start coming down or it will stay there. So if it is staying there, then also right now we are having good amount of money because we are creating a lot of inflation. That means that amount can help. That fund flow can help in the growth of the economy.
हाँ
So ultimately, what we were doing till now, that the same thing can be continued even if interest rate stays there.
yes sir.
So if same thing stays there, that means our economy is going to grow. We will be producing more goods. We will be demanding. We will be producing more jobs. We will be giving surplus funds in the hands of the investor, and they will start demanding a lot of things. And because of which markets will also rise. That means overall my GDP, my economy will grow. Correct. Now the third thing, if my interest rates start coming down, in that case, surplus will start increasing.
हाँ
Correct. Surplus
yes
will
sir.
start increasing. So right now I was able to contribute only 10 rupees. Now because of the interest rates coming down, I am having another 2 more surplus rupees. So I am now
That is
contributing 12.
12.
10 to 12, it looks very small, but now compare it in the terms of percentage. 2 is 20% of 10. That means now I'm contributing 20% higher in the,
No.
so my economy can multifold it.
Okay.
Because of this 20%, I can have a gain in the economy, maybe 30, maybe 40, maybe 50%. But at least 20% I will be having gain because 20% extra funds I'm infusing in the economy, right? So I'll have gains at least 20% extra. So ultimately, my economy is growing. Can I increase these interest rates from here beyond a certain point?
So but फिर वो limited है क्योंकि हमारे
Yes,
पास
sir.
तो
Can we increase? Can we increase beyond this point?
Yes, sir. Yes, sir. Yes, sir.
What would be the scenario if we have to increase?
So if interest rates are stagnant, that means other products would have an opportunity to grow, right? Say debt
Correct.
would probably increase their interest rates, right? So suppose if corporates need money and interest rates of say RBI or government is stagnant, they start issuing either debentures or bonds. So then I can start investing in those. Then simultaneously, once corporates start getting money, say through debentures and bonds, obviously they start increasing their operations. So they'll start expanding. Then because of like a chain reaction on that, stock prices will start increasing. Then I'll start investing in stocks of those companies.
Okay. So basically, you are saying when interest rates are staying as at the same level. I agree to your point because that also we explained the same. Ki when the interest rates are staying at the same level. Now I am asking, can interest rate increase further from this level?
सर बढ़ सकता है बट वो उतने ज्यादा कैपेसिटी में नहीं बढ़ेगा क्योंकि फर्स्ट सिनेरियो में हमने बोल दिया कि हमारे पास लिमिटेड है
नहीं नहीं, लिमिटेड है नहीं, वहां पे
So
लिमिट
which interest rates will rise? You're saying which interest rates will
repo
rise?
rate.
Are you
So
asking?
repo rate, because everything depends on the repo rate. So I am talking about the repo rate which RBI rises. Because every other interest rate in the economy depends on the repo rate. It's dependent on the repo rate. Every other interest rate. So I'm saying, can we have another increase in the interest rate from here? Maybe right now, let's say we are at 7%. Can we say that the interest rate will rise to 10%? Is it possible?
No, sir, technically not.
It is possible. It is possible depending upon the situation. Let's take Elstay's example. We will wind up in 5 to 7 minutes. So as Elstay rightly mentioned, that if the interest rates are stagnant, then definitely corporates will start raising funds either from the banks or from the bonds, right? Bonds directly goes to the investors. Again, it's the investors' money. It comes via bank route or via investors directly. That doesn't matter. But when they start doing that, they start getting funds and they start expanding their activities. They'll start creating more jobs. More jobs means more money in the hands of the investor. More money in the hands of the investor. They start demanding more. When they start demanding more, then definitely again inflation will start rising. Now to curb the inflation, again RBI has to increase the rates, right? So basically, right now the current inflation has not come in control completely, and all of a sudden, if the corporate activities start rising up, so they can increase the inflation further. They can add on to the standing inflation, and that will be on the higher side, right? So inflation will be a mammoth, then RBI will have to raise the interest rates. It can go beyond a certain level also, depending on the economic situation. Now, what you were answering is ki right now, considering the economic situation in India, will interest rate rise? For that, answer is no, because now we don't need any interest rate further, any hike in interest rate further, because our inflation is more or less controlled, right? From here, we have either a status quo or we have a downside, right? So both the situations are different. Now the thing is ki when interest rate coming down, definitely there will be a lot of liquidity in the equity markets, and we will see an upside in the equity markets also. So accordingly, we will choose the asset class. If equity markets has a higher probability now, because if it is staying as, I mean, interest rates are staying as it is, then also equity market is rising. And if they start going down, I mean, interest rates start going down, then we will be having a higher rate of running in the equity markets. That means in both the cases, we have higher probability of equity markets performing better, right? Because of this particular probability, we will earn more into it. So now comes into the risk profile. Who is conservative, who is moderate, who is aggressive, what is their horizon after these things. So first view is always on the market. First, we understand how the market is playing. What is the probability of earning returns, return of capital and return on capital, that we understand, and then we allocate the assets. So Elstad, this is what you will have to look into, and then you have to go into the asset allocation part, right? Wouldn't the risk profile of the customer change based off the market? No, risk profile of the customer never changes. So it is like कि हिंदी में कहते हैं ना कि पूत के पांव पालने में सुहाने. That means these are attributes, psychological attributes which never changes. If I love to take risk, I will always take risk irrespective of I am at 0 or I am at 100 crores. If I don't love to take risk, I always want to play safe and conservative. I will always play safe and conservative, irrespective of I might be having 1 lakh crores. I don't like to lose money, not even a single rupee, irrespective of what amount I'm having. I will never be. So risk profile has nothing to do with risk profiling here. Definitely changes the greeds. So, for example, me and my dad, we both have different risk profile. I am an aggressive investor. I love to take risk, right? My dad has always played conservative. So my dad is a conservative. He has a lot of money. I mean, he is filthy rich. I am not. I am yet to become one, right? Though he is having wonderful money in his hand, but still till date, he has never invested a single rupee in equity markets. उन्होंने अभी 3 महीने पहले एफडी किया है, जो उनको मैंने मना किया था कि एफडी मत करो, इक्विटी में डालो. नॉट 3 महीना पहले, समवेयर अराउंड 7 मंथ्स पहले मैंने उनको बोला था कि एफडी मत करो, इक्विटी में डालो, यू विल गेट मोर. नहीं डालना है, चाहिए ही नहीं. मैंने कहा बॉन्ड्स में डालो, वो भी नहीं, क्योंकि बॉन्ड्स उनको नहीं समझता है. सो बेसिकली कंजर्वेटिव पर्सन विल ऑलवेज बी कंजर्वेटिव, एग्रेसिव पर्सन विल ऑलवेज बी एग्रेसिव. दिस इज अ साइकोलॉजिकल ट्रेट, बिहेवियरल ट्रेट विच विल नेवर चेंज. सो understanding the markets, understanding the risk profile, then it is a matchmaking. Can I also consult, can I as a consultant charge the risk profile, change the risk profile? No, you cannot change the risk profile of the of a person. You as per the SEBI guidelines. Tell me.
So suppose say I'm working say for a wealth management company, and I get a client saying, let's say a client in his early 20s, he has nothing to lose, but he still has a very, let's say, conservative mindset.
Correct.
Versus a client who is in his mid 40s, has a family to take care of, and he has a, what do you say, aggressive risk profile, say. Then isn't that kind of a mismatch? Because then I can try to convince the 20-year-old, see, you have nothing to lose. You don't have to worry about a return of capital. Rather, you just have to focus on growth. Versus a person who's in his 40s, Say he has the aggressive risk profile, but then
Correct.
I tell him you have to focus on return of capital. You need to make sure your investment is safe and then focus on growth because he
Correct.
has a lot more to lose than the 20-year-old. So
Hmm.
can that happen? Does that
So
happen
what happens
in the
in this
market
is,
or
see, when we talk about the risk profile may age and capacity and appetite for the risk, they both are considered. First thing is, so when you say 20 years, so definitely out of all the 4 5 points, 1 point is in favor that he has a lot of time. Because young age means he has a lot of time to see the cycles. Why we say a lot of time? Because when we are talking about the risk profile and returns from the equity markets, what exactly happens is the equity market is a cycle which performs in 8 to 10 years, right? When 8 to 10 years it performs, then definitely in 8 to 10 years we know that whatever instrument we have chosen in equity market, we'll get the returns. We are sure about it. So if a 20-year person is investing, we can blindly say if you want these funds after 10 years, what we were talking today in the afternoon, that if you want to invest this amount for 10 years, I can blindly say you should invest into equity markets. But understand this thing that it has a fluctuation in between. A conservative person will
yes,
not be able to handle that fluctuation. Let's say you started investing in 2019, 19 mid of June, your portfolio was going wonderfully good till February 2020, but all of a sudden in March it went down by 50%. Your client will die out of heart attack because it is not of the age. Now, the second point comes into that if your client has a risk appetite, first thing, and a intention to take a loss. Intention means intentionally you don't want to take loss. Intention means if he can take a loss or not. Appetite is okay. I'm having 100 crores. I have an appetite to take a loss of 2, 3, 5, 10 crores. Okay. If 10 crore goes off my portfolio, I'm completely okay. I can still manage. I can still live a lavish life, right? So that means I have an appetite to take 10 crores of loss. But do I have intention to even lose 10 rupees? I don't. I don't like to lose a single rupee. I get scared. I get, irritated. I get frustrated कि मेरा 10 रुपए भी क्यों गया? That is what intention is. So these two things are covered in your risk profiling. While you do risk profiling, if somebody is not at all ready to do that, then you cannot suggest, as per the SEBI guideline, you cannot even suggest equity to that person. That person has to answer. Now, to answer your question in whole soul, age definitely is a factor which adds on. But again, if a client, irrespective of the age, is not ready to take that particular investment in the equities, he will not be able to handle. So you should not suggest. Considering the scenario, like the economy is doing wonderfully good, right? Economy will be doing wonderfully good for next 10 years. Let's say I gave a equity investment to a client. He will happily take that particular investment till it is doing good, till it is giving wonderful returns. As soon as your returns start diminishing, your client will start panicking, and once he starts panicking, he will make your life hell, right? So you cannot suggest. Now, to answer it more, to add on more, every risk profile has a equity portion. Conservative does not mean that you should not put anything into the equity. It only means that you are reducing the allocation of equity somewhere around 10% to 30%, again depending of the client's profiling and client's understanding. In aggressive, you put investable surplus on the higher side when markets are good. Like when right now, when we are seeing, if you're investor of the 40 years age, if he says ki I have surplus funds which I want to invest, which I don't need till 10 years, or beyond 10 years I will be requiring it after 10 years, then definitely you will allocate that particular funds somewhere around 90% into equities because of the risk profiling and because of the other factors. But considering the same scenario when in 2019 or 2018, when every proprietary model was showing that we should be cautious, equity allocation was reduced to 50% for aggressive profile, not for moderate, for aggressive. That in your portfolio, the equity allocation should not be more than 50%. 50% should be in debt. This is what happens when market scenario changes, then allocation also changes. And this is what we do with our clients also. When markets are good, we allocate higher side on the equity, and when markets are not doing good or when markets look like in a distribution phase, we reduce equity and we try to allocate the same into the debt side, so that in the times of downfall, the equity should not show much, the portfolio overall should not show much of the downfall. This is what we do in the equity portfolio management. Did I answer your question completely, or is any confusion further?
Got it, sir. Sir, but there is another thing that I wanted to talk about. I think we might have skipped overshot our time limit.
Uh-huh. Okay, done.
So I'll talk to you about that on call.
No
later.
issues, no issues, no issues. We'll talk about that. Okay. Let me stop recording first.